Hello, everyone. My name is Mike Sebastian. I'm with AppFolio Investment Management. We're a software company that provides software for investment managers. I'd like to welcome you to our discussion today for IREI and are talking about some topics in real estate today. I'd like to start by introducing my co-panelists, Jade Dye with GL Capital and Brian Briscoe with 4 Oaks Capital. Jade, can you please give yourself an introduction?
Sure. Thank you, Mike. Thank you, Institutional Real Estate and AppFolio, for having me. I'm very honored and happy to be here. I'm the co-founder and the CFO of GL Capital. We are a real estate investment company making investment in student housing, mixed-use properties, multifamily properties in Maryland, Pennsylvania, and the Virginia area. We have more than over 100 investors making investment with us from the United States, Canada, England, China, Singapore, and some other countries. And my job for my company is investor relations and finance.
Thanks, Jade. And Brian?
Yeah, hey, thank you very much for allowing me to be on the panel today. My name is Brian Briscoe. I'm a partner and co-founder of investment company 4 Oaks Capital. We're also the director of the Tribe of Titans, which is our multifamily educational community podcast host as well. We run the Diary of an Apartment Investor podcast. And then as far as real estate, 4 Oaks right now has, 9 properties under management. We are the lead sponsor on all 9 of those properties, total of 629 units. To be exact, worth probably 40 to 50 million, depending on where you pin valuation on any given day. Also, I'm a retired Marine, spent 20 years active duty in the Marine Corps, and other than that, just my main focus with the company is the educational products that we put out, and making sure that people are doing their jobs on the inside.
Great. Well, thank you both for attending today. I'd like to kick off our roundtable with some just easing into the general sentiment of, their general business sentiment for today. We're in a world now where, we hear a lot about cap rate compression, and there seems to be a rising interest rate regime. And so let's start off, and Brian, I'll direct this to you first. How has your business strategy changed over the past 6 months?
Over the past 6 months, you mentioned cap rates have compressed. It's harder and harder to find really good deals is kind of what it is. And part of that is I think our own fault for not adjusting quickly to the price hikes that we've seen. We've seen a lot of properties that have traded at one price a year ago, trade at 15 to 20% higher now, or even more. So I think part of the issue is a lot of people are putting money into real estate. There's people who are selling and doing 1031 exchanges and pushing the real estate prices up. There's a lot of hedge funds that are dumping money into real estate. So when you look at the capital that's flowing into real estate right now, prices are going up, and it is kind of hard to keep up with that. It's kind of hard to keep up with pricing when it changes so quickly. But yeah, as far as our business strategy, we've been doing C-class value add for quite a while. All 9 of our properties are C-class value adds. So looking at that, I think this is one of the questions on later. But one of the things that's changed is the delta, or the spread between C-class value add prices and A-class prices has narrowed quite a bit. So we're looking at potentially getting into something larger, maybe B-class with a light value add component instead of the C-class value adds, just because for the amount of work you have to do on C-class. You can get the same returns now in B-class and sometimes A-class that you used to only be able to get in the C-class value add space.
That's very interesting. Jade, how are you adapting your business over the last 6 months?
We still focus on multifamily student housing, mixed-use properties, what we usually do. But I agree with Brian. It's very, very hard to find great deals because the especially for multifamilies, it's very overvalued. When we have deals, when I call the brokers, okay, so you send me this deal, what's the cap rate? in the past, it's very easy to see the cap rate like above 7%. But now when they tell me it's about like 3%, 4%, and very few I saw 5%. So it's very difficult for us to find undervalued properties. But we still want to stick with it to always find undervalued properties. That's very important for us, because once we buy properties undervalued, then we can earn money, right? And when the property buy undervalued, then we can add value to the properties. Then we can do refinance. We can have our capital money back. So we still want to stick to that strategy. However, because of the inventory of properties are less, so we adjust. Instead of just focusing on the Maryland, Pennsylvania, Virginia, we also expand to the Delaware and the Georgia area, and expanding the location. And also, we are from our previous experience, like our success from like the refinance, like the deal we bought. When we bought one property, when we bought was only 40% leased out, and the property's value are tied to the how much rent the property can collect. When we buy the property is undervalued, it's 40% leased out, then we could renovate it, and then we can fully lease out. Then after we do refinance, then the valuation almost double the valuation, and then we got back the more than 30% fund back. So we want to stick to that strategy. However, multifamilies now is occupancy rate also are very high, so it's not that easy to find like the undervalued properties. So we are also changing to find some vacant office, and also to turn the office if in the zoning, it's not that difficult to change the zoning to multifamilies. So we also handled one success in the past to turn the office to the apartments. So we want to do something more like that. And we believe because the vacant office, you don't have that much rent, then the value will be down. So we still want to stick to is the undervalued properties add value.
Very good, thank you. And just to stick with this, I know you've both said how difficult it is to find deals in today's market. How are you approaching that right now? And do you have any tips or tricks that you might recommend to the audience for looking at where to find deals in a market like this?
Yeah, I think a lot of things haven't changed, as far as where to find deals. I mean, for existing multifamily, it's still through brokers, and really you just have to cultivate the relationship with brokers, and you have to have a reputation of being a closer, and that way, when the broker gets the deal, what the broker is going to do is pick up the phone, and they're probably going to call, the first 5 or 6 people that come to mind that would be interested in that property to see if they can get a quick movement, a quick offer without having to do a lot of work, and I mean, that's what I would do if I were a broker anyway. But, as far as finding the deals, you've got to understand what's going on in the marketplace, and right now it's the marketplace is demanding hard money down day one for most metros, most asset classes, and most properties. So, when you put that contract in, or when you have that contract signed, you have to be ready to wire a non-refundable deposit. And a lot of times, once you're done with due diligence, you're wiring another, big chunk of change over. And that's just because of how the market is. It's very much a seller's market. And the sellers want an assurity that they're going to sell the property. So, really it's just a matter of, like I said, cultivating the relationships with the brokers, to the point to where you're on the first round of calls or emails that they send out on a given property. And then being willing to match whatever the going market terms are for purchasing properties.
Thank you. All right. I'll go ahead, Dai. I'm sorry, Jade.
Oh, I'm doing a little bit different than Brian. We are doing because from the broker's deal is very competitive, because a lot of people are checking the broker's deal. I agree we should have the good relationship with the brokers, but beyond that, we're also using the CoStar. I like using CoStar. When we're using CoStar, we can find like some off-market deals. We also can find who are the true owners. They can give us some chance to talk to the true owners. Even though it's very difficult to really reach out to the true owners, but at least give us a a platform to try that. Besides that, I will also suggest like the a lot network and the talking to people, and sometimes have the owners that want to sell the properties.
Some great suggestions on how to go about finding properties in today's market, which is tough. So I want to pivot to another topic, fundraising in today's market, and we'll talk about that. Before I get into these questions, I just want to remind everybody who's on the webinar that if you have questions for our panelists, there's a Q&A button down at the bottom of the Zoom box or Zoom screen, and that would be the screen that has all of our wonderful faces on it, because I know there can be a couple different Zoom screens up there. So if you look in the bottom, it'd be the one on the right, and please feel free to type in your questions, and we'll get to those in a little bit here. All right, going back to fundraising in today's market, what does the availability of financing look like in the markets you're operating in? And Jade, why don't we start with you first?
Yes, we have over 100 investors making investment with us. So for the equity side, it's not that difficult. Not like finding deals are more difficult for us. So investors, like after we refinance, it's like, what's next deal? What's the next thing we can make investment in? So equity part is not that difficult. And also for the bank side, I will say it's still very good. The last rate we got for our multifamilies was 3.25%. Was very, very great. So I think now still a good time to get in the loan from the bank to get a good interest.
That's great. Brian, what are your thoughts on that?
I agree with what she said. Equity side is easy. I mean, the stock market's done well. There's been a lot of people who've done well with cryptocurrencies, and a lot of people who've done well in real estate who are exiting deals with a lot of cash. So finding equity is not the problem. On the lending side, with prices where they are, the two biggest things lenders are looking at, they have a maximum loan to value that they're willing to loan out on a given property. And they also have a minimum debt service coverage ratio. And what's happened a lot is the property prices have gone up a lot faster than the income. That's the cap rate compression coming in. And so it's harder to get the same debt service coverage numbers as you could 1 or 2 or 3 years ago. And so really what we're seeing, especially on the long-term financing, your Fannies, your Freddies, your other agency loans, is that you're not getting the amount of proceeds that you could have gotten a couple of years ago on the same exact property. So I think what that's doing for a lot of people is, in order to make some of these deals work, is they're pushed into bridge financing, and bridge financing comes at a little higher interest rate, but it's a lot easier to get, more money from the lender. And, depending on, where you get your financing, you can still get pretty good rates. We got a bridge. Our last 2 bridge loans were from the same credit union in South Carolina, and both of them came with a 3.7% interest rate and 80% loan to value. So, I mean, when you look at the financing, it's out there. It's just that you may not be able to get the proceeds that you may be used to 2 or 3 years ago going agency.
That's interesting. So it sounds like interest rates are still pretty historically low. In the news, we hear about every day the threat of rising interest rates to fight inflation. Do either of you anticipate rising interest rates, and are you accommodating that into your models going forward?
When I do the underwriting, yes, I definitely put a higher interest rate when I do underwriting, just to be more cautious. And also because of hearing the interest rates going up, so we're also pushing our refinance.
Yeah. And so what we do, and we've always done it this way, is we never put refinances into our numbers. The deal has to work without a refinance for us to do it. So from the very beginning, we kind of had the philosophy of, if rates go up, we still need to be able to deliver what we projected in the beginning. And the other thing is, if your deal hinges on that refinance at a low rate, it's not, I don't think it's responsible underwriting, but so for one thing, that's what we're doing. But when you're looking at rising rates, there's a lot of things that are going to happen. Rising interest rates correspond to higher rents, so when you look over the history, whenever interest rates go up, home affordability rates go down, because it costs more for people to buy homes. I mean, the prices don't change, but the monthly mortgage cost is going to be much higher, which actually pushes rents up as well. I mean, there's also correlations between interest rates and cap rates, but I think in the last several years, that correlation's just kind of gone out the window. But with rising interest rates, I think the biggest thing we're looking at is it's probably going to keep pushing rents up. It's probably going to have a positive impact on occupancy, which are good signs. It may have a negative impact on the pricing. So if our interest rates to buy go up as well, there's going to be fewer people that are able to hit the prices that properties are going for right now.
I see. Well, speaking of refinances, I know you mentioned that. So it sounds like refinancing is still an option on your existing properties, and at least for the foreseeable future, that continues to be. Would you agree with that?
Yeah, absolutely.
Yes.
Gotcha. Well, that's good. Good to know. Let's talk a little bit about investor expectations in today's market. So, are your investors perceiving any challenges or issues in the market today, and how does that filter down to you?
Our investors, they're making investment with us. So usually we provide them like the good cash on cash return, like the 8% cash on cash return, and also the good IRR. But now, because the market is more competitive and it's not that easy to get great deals, so we are lower the expectation from our investors. So instead of expected the more than 8%, we would like to be the minimum 5%. Mm-hmm. But however, when we buy in properties, we are not like the compromise like our investment criteria. We still want to go after the undervalued properties. So that's why our strategy switched to target more like the vacant office to see we can get more of those properties, and then to make our investors have them high expectation. But if we get excellent deal, then you definitely be very happy.
Yeah, and I would say that with one of my partners used to use this example. It's multifamily or real estate in general has been on the top of a rocket ship, and the rocket ship's going up. And I think a lot of investors have seen IRRs in the 50 to 80% range on some of these properties. It has nothing to do with how good the sponsors is, but it has most to do with what's happening in the real estate market. And where prices have gone, I think some of the investors' expectations are, every deal is going to be a home run. And we've had a couple of unsolicited offers on our properties, probably from people like Jade who have CoStar access, who are just reaching out to us. But we've gotten a lot of unsolicited offers on our property sight unseen, and we've looked at the numbers, and it's like, if we sell at that price right now, we're tripling our projected IRR. And it's just the nature of the market right now. So there's good things and bad things. I mean, it's really good if you own properties, and if you own properties for 3 or 4 years now, the prices on those have probably doubled. But on the flip side, with prices so high, I don't think you can expect the market to keep on going up at the same pace. And so, we're having a hard time projecting, these 15 to 18% IRRs that we were able to do 2 or 3 years ago. And, I think the investors eventually, their expectations are going to have to come down based on, where the market is headed. Is the market going to continue screaming like it has for the last year or two? I don't know. But, at the same time, we like to underwrite as conservatively as possible and make sure our returns are in the bag before we put an investment offering out. So I think it's going to have to change. And I think most investors are going to have to start getting used to, pro formas with maybe a 12 to 15% IRR on it.
Yeah. That's really interesting. You would think with the cap rate compression, it's going to compress IRRs, if interest rates go up, and it's hard to imagine they don't in the next at least couple years, right? That puts an extra squeeze on you. So you would think that would also compress IRRs. But yet at the same time, if the and I'd love to hear your thoughts on this. If the interest rates continue to go up, that's usually a bad sign for stocks and the general public markets. And so it seems to me that will drive investment to real estate. And so I'm curious to hear your thoughts on that.
I think it already has a lot. I got a good friend that's a hedge fund manager, and I talked to him a lot. And he was looking at his tea leaves, 6 to 12 months ago with all the talk of inflation and eventual rising interest rates. I think a lot of people have already postured themselves to, be in a safer position to be invested in hard assets for whatever is coming, whether it's, more inflation at the, 5 to 8% level like it was in the last year, or whether it's, rising interest rates that are going to, slow the rest of the market down. And I think you're going to see more of that happening. But I think a lot of it has already happened.
Interesting. Are your investors demanding more transparency into these deals? And what does that look like?
Usually from us, we have like the JV partner investors. Also, but most investors, the 100 investors are passive investors. So for the passive investors, they're not demanding more than the past. But for the JV partners, of course, they also want to know more about what's happening for the properties. But now we are doing good, especially after we started using technology, AppFolio. Before when talking to the investors, I'm responsible for investor relations. There are more than 100 investors. If they want to know what's happening to the properties, it was headache for me, because I need to talk to them, and it's very time consuming, and I also want to maintain a great relationship. Even just send email to them. It's not good. I just send by group, because my investors, they are in the different properties, and different properties they have and have the different investors. So it's not that easy. But however, after I use the AppFolio, it's very helpful. I upload our investor reports quarterly, and also communicate them via the portal. They can always to see what's happening to the investment, like how much they made investment, what distribution they got. And once they see that, I got the less questions from them. So I would say now I hear less questions from my investors compared to the past.
So just giving them some sort of access to have self-service access to that kind of information has been helping you, and they've been reacting positively to that. Brian, any thoughts on that?
The question was, are investors seeking more transparency? We also use AppFolio, and I love the investor, relations or the investor management software. One of our investors texted me last week and said that he loved it too. Everything was right at his fingertips. But as far as are people demanding transparency, through AppFolio, we can actually, we send out our monthly investor reports on all of our properties, and we can go back in and see how many people have actually looked at them. And I would say the answer to that question is no, because, we're probably getting a 20 to 25% open rate on our monthly reports. The reports that get seen are the ones that, correspond with our quarterly distributions, so the monthly reports, we're getting a 20 to 25% open rate on the reports. So are they demanding, more transparency? Maybe the dashboard and AppFolio, we haven't asked this question, but, maybe the AppFolio dashboard's giving them enough information. And maybe that's all they're looking for. But yeah, we upload our reports in AppFolio. It gets blasted out in an email. And it's super slick. You click the link and it takes you right to the report. So there's no logging on. But like I said, we're getting about a 20 to 25% open rate on reports. So I'm not sure that they're demanding more transparency. I think the people who want the transparency can get it, and the people that are just happy to let their investment ride are doing that as well.
That's great.
Go ahead.
Sorry, Brian, that's great. I like your investors. When I upload the reports, it's like the 90% of them open like the reports. Yeah. And some investor, they would ask me questions, some of them. And we also have investor they made investment the more than 3 years. Then they ask me, they wonder, okay, Jade, I wonder how much distribution I got in each year, and the average return is how much. If I didn't use AppFolio, I would go to their K1 to calculate like how much they made in that year and how much they got back in that year, and add back, they send to them. But now it's very easy. They have a lot the tiny questions, like the distribution things. I can just the log in AppFolio, the screenshot, how much in total they get, and send to them.
Yeah, and we definitely have squeaky wheels. I'm not saying that we have a bunch of apathetic investors, but we do get a lot of questions from them. But I do think that going back to not supposed to really try to push products or anything, but going back to AppFolio, it does provide a lot of that information they're looking for, and I think that takes care of a lot of the potential squeaky wheels on our end.
So if I were to just say, if we, going up a level, and I wanted to pivot to talk a little bit about, if anything's changed in investor communications, just generally speaking, but just having some sort of a solution that allows investors to log in and get the information they need sounds like, a trend moving forward. So, Jade, I didn't mean to cut you off. Go ahead.
No, yeah. I think that for communication side, because also COVID happened, I think everyone's get used to just communicating online using Zoom, using Microsoft, and my investor from China, we're using WeChat. So online meeting is very common. And in the past, the investors come, we more like the meeting in person, than having lunch, dinner together, but now it's less than before. But the technology makes it very, very convenient. And also the different technology we are using definitely help us to increase the communication touching point with our investors. So I'll say the business owners like us, if you haven't tried any technology yet, to managing your property investor, you should definitely try. That can decrease a lot of the times and the efforts.
Great, thank you. So has anything changed in the last, well, I mean, obviously we've been going through the pandemic, and now it seems that we're starting to come out of that. So just in terms of the cadence and that pattern of communication, has anything changed, irrespective of the software or the, how you've been doing that? Any change in patterns, or do you perceive any changes going forward?
For us, we made a commitment, when we purchased our first property as syndicators, to do monthly communications. And, I think that, we haven't changed that. We haven't changed what we have communicated, but the how has changed. And I think the investor management side of AppFolio has become a lot more robust over the last 3 years since we signed up. And it makes it easier for the investor communications. But our general monthly reports that we're sending out, the content has not changed, just the way.
Got it.
Yeah. Yes, I think that our investors, because they are not just from the United States, they are also from other countries. For the investors in the States, when they log in the investor portal, it's very easy because they can see what's really happening for the investment. And but we still facing some difficulties. We still want to provide the same customer service, same investor experience to the investors who are not from the States. So I wish AppFolio can have something like that for other countries too. So we're still looking for the technologies can help us, even though in a different language, in Mandarin or some other language, the investors from other countries, they also can be very easy to see what's happening for the investment. I'll see in the future, we still want to keep the eye on to see about technology part, how technology can help us to save time.
Great. All right. So speaking of challenges in the past year, we've all been kind of on lockdown and working from home for the most part. I'm curious to see, are you back in the office? Are you starting to make plans to go back in the office? How's that working out?
Well, simple answer for us, we're still a really small company. And so, our for the most part, I've been working in a home office. So I guess I haven't left my office, but we do maintain a small office in North Carolina. And because it was a small office with only 2 or 3 people showing up on a daily basis, we just went through regular protocols. When people were sick, they stayed home. And just because of the relative small size of the operation, we didn't change a lot of how we operated on a day-to-day basis as far as where we're working from.
We still working online. Even though before the pandemic, we already switching our employees to work more online, because we feel like they can work very efficient. And any issues, anything to communicate, it's not like they have to meet in person to communicate. It's very easy, just the meeting call to solve the issues. But we also think that having a good culture is also very important to building the culture in the company. So very interesting. This morning in our manager meeting, we were just talking. Maybe we should meet at least once a week.
And that sounds great. So are you hiring, and are you planning to in the future here? And what do you think the implications are for that in the still work from home environment? How are you handling that?
Well, we are hiring right now, but that's partly because we're working on bringing property management in-house. So a lot of the hires we've made were people who were already on site, on a property manager's payroll that are now on our payroll. But we are looking out to put the right people in place for our property management team. We've got a couple of general contractors that we like, and we're starting to use more and more frequently. And I don't think it's going to be too long before we bring, the construction management in-house as a salaried employee soon. And I say the same thing with an asset manager. That's on our list of hires coming forward too. And and fortunately, we do have a lot of technology. Fortunately, there's a lot of applications out there, where we don't necessarily need to maintain an office to do it. We can do all of our communications over Zoom and get together as needed. And so yeah, as far as implications for hiring goes, I think we're in a good spot. And COVID may have helped us out a little more because everybody is accustomed to virtual meetings and talking over Zoom like we are right now.
Yeah, we just brought 3 new members to our companies in the last few months. 3 are local in the States, and 1 is a virtual assistant. I totally agree with Brian said. A lot of things actually can handle online. For example, like the leasing lead, like the people want to ask him, where's your apartment and how much it is, what's the square foot? Or like the tenants have the questions, the maintenance coordinator, I have some issues. Those people helping for leasing assistance and the maintenance coordinator, we hire virtual assistants, and it's worked very well. And the salary we only need to pay like the 1/3 compared to the local people, so it can save a lot of a cost for the company. And so I'll say if the company haven't tried virtual assistants yet, you should try. That's very helpful. But another 2 members we brought in are local, because we also have a property management company. We manage our property in-house. We're also helping other owners managing their properties. So we still need people in person, but the hiring cost now is high and not that easy to find people. So need to pay more money to hire good people. But I'm very happy for the 3 members we are having now.
As you know, that's an interesting point that leads me to another question. I think, Jade, your company's doing construction, right, or renovations?
Yes, we do that too.
And so with respect to the hiring and the cost of hiring going up, are you seeing any challenges with the construction with, we hear about supply constraints and the challenge with finding people to hire. So how is that affecting your construction projects?
It is. So we were lucky. Well, we only have one project under renovation, and we purchased all the materials. We ordered that all a year ago.
Oh,
so we were lucky. But for our future deals, like the coming deals, we definitely put more under, put more like a higher price in our underwriting analysis deals, and also for the ethnic materials now is very high. It's very high cost. So it's hard. It's hard. So we're making our profit margin will be lower. So it's difficult.
That's interesting because we're in this now we've talked about interest rates going up. We've talked about cap rate squeezes and rising property, and now you add on to that the compression from the construction costs. It's something to factor in, but you're still able to make it work.
Yes, so that's why we should always see what are the innovative way we can do our business and which area we can save cost. So that's why I suggest we have to use technology and also try virtual assistants, and also something just that the virtual assistant to handle.
Gotcha. Before I go to the next section here, we have a couple questions, and I was going to try and wait to the end, but these just seem like they fit right into our discussion right now. So let me ask you both this. The first question from the audience is, when fundraising and building your investor list, are you utilizing Reg D, 506B, or 506C?
I use both. Oh, sorry. Go ahead.
You go ahead. You hit it first.
We use both. Depends on the project. If the project's very tiny, we don't need to present to a lot of investors. The 506B and for 506C, if we want to do a presentation to have more investors involved in, we are going to do that.
So the question about building your investor list, I don't think it matters whether you're doing a 506B or 506C. I think you have to build relationships with investors. 506B pushes you to have, connections. You're not allowed to, generally solicit. And so one way to get around that general solicitation is to have a pre-existing relationship, and I think building that relationship is before you put somebody on your list, so to speak, works well, regardless of whether you're doing a 506B or a 506C. So we have only done 506Bs up to right now, but I don't see anything changing on, how we're attracting investors and what our internal processes are, getting investors onto our investor list when we do flip the switch to 506Cs.
Gotcha. Thank you. And then there's another question here from the audience. What do you see happening with the recently dark standalone drugstore sized buildings? Which new tenants do you see coming in? Thank you. Now, Jade, I know you said you were doing an office conversion, which sounds pretty close to that. Do you have any thoughts on that? So the question was, any thoughts on what do you see happening with basically drugstore buildings that have gone vacant, is how I interpret this with a drugstore size building. So I would interpret that as single tenant retail. But
I would say if the single tenant buildings, definitely it's high risk, right? And also the retail now is not that easy to lease out. I do have a retail plaza in Norfolk, Virginia, and that one is fully leased out. Before, I think it was before COVID, when we were fully leased out, our cash on cash rate was beyond the 9%, 10% was excellent, and the IRR is over the 20%. However, because the retails, we only have a few tenants. Now we had one big tenant move out. Now our income can only just the ability to cover our cost. So I would say like if only like the one tenant buildings, it high risk, because once that tenant move out, it's like how can you maintain that buildings? And else you wanted to like to change the building, you want to do something else to make it a de-risk.
Yeah, it's interesting. I was recently on another panel talking about retail, and not to get too off topic because I know we have a lot of multifamily in the audience, but they were talking about how retail is making a comeback, and they're starting to do construction in retail again, which is interesting. Of course, this sets aside malls. We're not talking about malls. But it was a pretty interesting topic to hear about, because you can still squeeze really, or at least relatively high cap rates out of retail if it's, relatively safe, meaning it's grocery anchored and you have stable tenants. And the sentiment there was that the pandemic has kind of shaken out the weaker retail brands, and so there's apparently retail brands that are having a hard time finding space these days, which is interesting. And then another question here from the audience. We'll just keep going with this, and then I'll pivot to our next section here. And I think this one's directed to you, Jade, is do you use a third party to manage the extra SEC compliance required by 506C?
No, we don't. For 506B and C, the only difference is that for 506B, you only can, for example, if I want a fundraising from Mike, from Brian, I have to talk to you directly. You're the people I know. I have to talk to you directly. However, if you are the people I don't know, if you want to talk to multiple people, you want to do a presentation, you have to register as a 506C. So that's the only difference when you pitch to the investors. Another difference is the second difference is the for 506B investors, because both all need like the qualified investors, which means the personal assets has to be at least $1 million. Or the income has to have the minimal income, or the institutional investor also have those basic requirements. But for 506B, like it's an investor. They say, like in a contract, they say they are qualified credit investors, and that's okay. But 506C, you have to verify each investor if they are the credit investors or not. So only for that part, you can use a third-party companies to help you verify, or you can use a content to verify, or you can use your investor has their own resource to verify. You don't have to hire a third company to help you to manage your 506C investment.
Great, thank you. All right, let's pivot over to the next section here. We have tax season coming up pretty soon here. So what are your biggest challenges or pain points during tax season?
Timelines. I mean, everybody's doing taxes. Every accountant is working 16-hour days, so really it's just a matter of being high enough in the stack that you can hit timelines that aren't pushing your investors to file extensions with the IRS. And it just really takes getting ahead of the power curve on that one, and having your ducks in a row as soon as possible at the year-end closeout to be able to get into the queue for the accountants. So we use a third-party accountant agency to do our taxes, and they have kind of a first in, first out mentality. So and then something else, we closed on a property on December 27th, very late in the year, and trying to get the K1s out, you have to do the cost segregation before you can get the bonus and accelerated depreciation onto the K1s for the investors. And I guess one of the big pain points on that one is just because we did a year-end close, we had to schedule the cost segregation study, which is going through the same thing. People who closed on properties in 2021 and just delayed are all now rushing to get that done. So I think our big pain point on that particular property is, the cost segregation study is supposed to happen next week, and then when we get the results back, then we send it to the accountant. So really it's just the timelines, and everybody who's associated or in the tax business right now are extremely busy. And so you just have to be ahead of it and, get your stuff in first.
Yes, I'm having the same headache as Brian. We changed the 3 accounting firms to trying to make sure we can send out the things on time. Then I realized actually it's not accountants' issues. It's just because there are too many properties under too many different companies. And before the accountants, they can send out the 1099 to send out the K1. They have to reconciliation all the transactions. And if we have more than 10, more than 20 companies, it takes time, right? Before we also had an issue. We had an issue to send out 1099 to the vendors on time, because that's deadline is January 31st. I didn't mean to advertising AppFolio, but it did help me to solve that issue, because so this year and when we send out 1099. I just download from AppFolio. The AppFolio, we pay our vendors all via AppFolio. So AppFolio already have the record how much I paid for which vendors from which company. So it's very easy. My accountants need to verify. No, we download the documents, and documents is not like an Excel sheet or Word. It's already is a 1099 can submit to the government. So that's very helpful. Then my accountant just submit that. That's awesome. So I'm looking for AppFolio to help us in future, to help us to send out the K1 on time too.
Got it. So it sounds like you have using the property management system. So property management systems can help organize all that data and get it organized faster. And then that helps feed into the investment management side, it sounds like. So I was going to ask if you had any advice on helping out with that. It sounds like, having an organized system that already has all the transactions that in some cases can generate some of these tax forms for you is one of those. Any other thoughts?
And really it just comes down to having your ducks in a row. Whatever system you use, you have to have your ducks in a row early to be able to meet the deadlines.
Yeah, sounds good. Okay. So want to talk a little about technology as, we get into the last 10 minutes or so of the conversation here. And again, if the audience has any questions, feel free to type them in now. We're going to get to more questions soon. So how does generally speaking, high level, how does technology play a role in solving some of the pain points we've been talking about today? So, we've talked about things like fundraising, remote employees, scaling a business, managing communications with investors. How do you see technology helping out with these different challenges in running a business?
Yeah, we love technologies. Besides the making investment in real estate, we're also making investment in real estate technologies, like early stage companies, because we always believe the technologies can help us to enhance our portfolio, to help us to save our time and the cost. And it does. Like the AppFolio, like Costa, like Zoom, all the technology we are using are helping us to manage our properties better, to help us to communicate with our investor more efficient. That's great. And for technology companies we are making investment in, I also love it. Like one company we made investment in is Senseware. It's called Senseware. Senseware is that they have a detector. They can detect they can track the record of the air. For example, if any the odd gas leaking, or if there's too much water in the air, they can detect that. So we use that for our renovation projects, or we use that in our basement to prevent mold. So I would say yes, always to check what kind of technologies can help you. It's very important.
So that it sounds like that's a sort of a prop tech solution to help get ahead of future maintenance, which can reduce costs. Is that fair to say? Okay.
Yes, because the sense where they can for example, if they have any the odd gas leaking, they would text us, also email us, and they also have a portal. We can check the checking of the air.
Very good. And Brian, any thoughts? Any kind of technology thoughts that you're deploying to solve for some of these things?
The struggle we have with technology is, going back, to, common phrase, 5 or 8 years ago, there's an app for that. Everything you want to do, somebody has come up with an app for that, or some sort of, tech solution, whether it's prop tech or, on the investor management side or the CRMs or whatnot. What we're finding difficult is the integration of technology, because, some companies are really good at one thing and they try to come up with a full service suite, but they're not as good at this piece or they're not as good as that piece, which, when you start looking at, pricing and what each of these technologies give to you, a lot of times people end up going like the a la carte version. Well, I'm going to use this company for this. I'm going to use that company for that. For us to do everything, now all of a sudden we've got 16 different portals to log on to check, the various things. So there's definitely a lot of technology out there to save you time. But like I said, our challenge is trying to do things smartly. So we're not into a billion different systems, where each one covers one specific area. And, we're still looking for, one complete solution that does everything well.
Yeah. Well, to that point, do you have a strategy for how you evaluate technology in your company? And what does that look like?
The strategy is, we don't have like a published strategy, but we need it to be simple. We need it to be usable. And bottom line, I think the best solution is the one that you use. There could be, lots of different, techs out there, but we've tried a couple of different productivity software solutions where, some people don't like it, don't use it. So really end of the day is you have to find something that everybody can and will use. And, that's a challenge in and of itself, but really we want to simplify and not make things complex. And, it gets to the point to where, you don't want another solution for, X, Y, or Z, because it adds complexity, even though it may gain you a little bit here or there. I think the added complexity sometimes isn't worth the gain you get from the tech.
Gotcha. And Jade, do you want to speak to your company's strategy for evaluating technology?
We are very open to see all the technology companies demo, because we always wanted to see what things are new there and what things we can adapt. But I also think it's also very important, like to get refer like from our like the people who are doing the similar things as us. So I think that it's also very helpful if we get referral from people. And besides that, actually, we also think about the price. Like a year ago, we didn't use Costa because the Costa at that time the price model, like only like a small region, like in Baltimore where we make investment, it would cost like the $1,000 only for a small area. But now after they changed the business model to be like the very, very reasonable price to cover the national, definitely. And also AppFolio, very, very easy to use and also very reasonable price. Definitely affordable. And that's also the one thing we will compare. And the one after we start using, and it's very easy. Like we are using AppFolio now for managing our properties, also managing our investors, and those things are combined together. I totally agree with Brian. If we can use like one thing to cover more things, but that would be easier for us. So now I feel it's very easy to use AppFolio for managing my properties and investors, because they are all under the same portals and the function are already very mature.
That's great. Well, that kind of leads into my next question, which is, what do you wish software companies today would focus on solving for you?
K1. I'm looking for AppFolio helping me to solve my K1 headache.
Generate them so you don't need to hire a CPA and get all the data. Yeah, that's a challenging problem.
Everything that you already solved, so that's great.
Yeah. Brian, any thoughts on, and if you could wave a magic wand and have any kind of solution, and what would, or just an area of focus, what would that be for you?
I'd just take the magic wand, I mean, that's what I would have. Yeah, I haven't put a lot of thought into, what would make things work better, but I think really end of the day, we're looking for something that has, is complete and simple, and that's really, I think really the bare bones. And my 20 years in the military, we just got system after system after system after system thrown at us, and technology solution and technology solution. And that seemed to be the go-to. But end of the day, I think the simplest solution is always the best. And I think sometimes the technology misses by trying to I think sometimes the technology ends up being too complicated. And we're just looking for something simple, easy to use.
Thanks. So this is my last question for the day, and I know we just have a few minutes left. And so I'll just, it kind of dovetails with what we just asked, which is, how can real estate executives make the most of the technology at their disposal to make sure that they're getting a strong ROI? So how do you get a return on investment out of the technology that you're getting for any kind of technology?
Really, like I just said, it just has to be something that simplifies the workflows, simplifies the processes. The more simple it is to do jobs, the more likely people are to complete them. And for the executive, you need to have the right information at your fingertips. So customizable dashboard. I know AppFolio does have that, but on the property management side and on the investment management side is something where you can customize to have exactly what your key indicators are, and the decision, and not extra information. So as an executive, both in the military and now with a business, we don't want to be overwhelmed with information. We want to have just the right amount of information at the right time.
Gotcha. Yeah, and to solve the technology has to be solve the real problem, the real issue for us. And also, if we use the right technologies, it definitely can save our cost. When we save our cost, of course, our ROI will be increased. For example, why we can using virtual assistants for leasing, and also for the maintenance. That's because the technology we are using, we can communicate with our tenants just use by the portal very directly, very easy. And then when tenants they have an issue for in the tradition, if a tenant they have an issue, if there anything leak or anything in their apartments, they have to contact the property manager. Property manager have to contact the vendor. The vendor have to go back to check what time tenants are available. It's a lot of communication between, and a lot the labor cost. But now the technology we are using now, when tenants have issue, they just they submit their issue, then the vendor can schedule the time on the portal directly. Our managing people don't have to be involved in. They already save our cost and also help the property to provide a better experience for the tenants already. So, and also I'm very excited to in future to use the AppFolio's Lisa. The one is the AI leasing agent. Then that can help us to replace our VA, to replace the one person we are hiring. Then they can just answer the questions for the potential tenants about how much is apartments and then where it's located, those simple questions. So I'll say right technology is definitely helpful. So that's very important to choose the right one to solve the right issue.
Great. Well, it looks like we're at time. So, we had a great discussion today, talked a lot about a lot of stuff, including market sentiment and, where the market's going and how to deal with cap rates. So I want to thank you both very much for your time and talking through these things with us, Jade and Brian. And I want to thank IREI for hosting the webinar. And thank you all for attending. Appreciate your time today.
Thanks for having me.
Thank you.